The Big Picture. Not long after this book first appeared in 1978, the U.S. financial tide ebbed. Stock and bond prices hit rock bottom, the result of sky-high inflation and interest rates. And so did our national debt, relative to the size of the economy as a whole. Investing over the next 3 decades, as difficult as it surely seemed at times, was actually deceptively easy, as the tide just kept coming in. Now we're in, roughly, vaguely, the opposite situation. Very low inflation, very low interest rates, and an uncomfortably high national debt, making the years ahead a particular challenge. Understanding that challenge, seeing the big picture, will help you put events and decisions in context. Take a minute to consider the national debt and interest rates. Then another minute to consider the good stuff. National debt. In 1980, the national debt, which had peaked at 121% of gross domestic product in 1946 as a consequence of the need to borrow whatever it took to win World War II, had been worked back down to 30%. It's not that we repaid any of it, just that the economy gradually grew to dwarf it. Whether for a family or a business, or, in this case, a nation, having a low debt ratio is healthy. It gives you wiggle room if you ever run into trouble, like a recession, and need to borrow. Indeed, that had long been the big idea, that in bad times, government should lean into the wind and run deficits, borrowing to boost demand and ease the pain while excess business inventories were gradually worked down. And then, in good times, not borrow much or even run a surplus to build borrowing capacity back up. Yet in the mostly good years since 1980, our national debt has ballooned. From 30%, when the Reagan-Bush team took over, it topped 100% in the fiscal year George W. Bush passed it on to his successor. Only between Bush Sr. and Jr. was the annual deficit tamed, as Clinton handed off what Fortune called surpluses as far as the eye could see. Although the deficit has once again been tamed as of this writing, meaning that the national debt is once again growing more slowly than the economy as a whole, the wiggle room is largely gone. I wrote in this space 5 years ago, with the unemployment rate hovering just under 10% and home foreclosure rates peaking, we will get through this and emerge more prosperous than ever. But the decade ahead will be more about hunkering down and retooling than about jet skis and champagne. And indeed, the unemployment rate has fallen to 5%, as I write this in early 2016. Foreclosures are running at their lowest rate since 2007, and the stock market is more than double its March 2009 low. So we did get through it. Even so, the nation's infrastructure has been allowed to decay badly. The national debt may require 35 years to shrink back to 30% of GDP, as it gradually did in the 35 years following World War II. And many of the new jobs don't pay nearly as well as the ones they've replaced. So it's still too soon for the champagne. Interest rates. In 1981, Uncle Sam said, "Lend me $1,000 for 2 years, and I'll pay you $336 in interest." In early 2016, Uncle Sam was saying, "Lend me that same $1,000, and I'll pay you $20. And people were rushing to take it. So it is a very different world. In 1981, investors willing to take a risk on stocks or long-term bonds knew that, if inflation didn't spin entirely out of control, interest rates would eventually fall, making the prices of both stocks and bonds rise. In 2016, investors have to understand that, whatever may come first, interest rates eventually will rise, making bond prices fall and stocks relatively less attractive as well. The more interest you can get from safe bonds,